This program is brought to you by the National Association of Insurance and Financial Advisors, promoting political advocacy, education, and the ethical conduct of its members nationwide.
Well, welcome to NAFA's Programs in a Box. Today we're going to be talking about the cornucopia of retirement plans, sorting through the maze of rules.
This is Nick. I'm Max. As we sort through this, we're going to deal with all the rules related to qualified plans and the things that intimidate a lot of advisors. Nick?
My name is Nick Paleveda. I am a tax attorney. I'm licensed before the United States Supreme Court, licensed also before the U.S. Tax Court, and currently I'm the adjunct professor for the Masters in Trust and Wealth Management program at Campbell University in North Carolina. I've been the lead faculty member and the adjunct professor for the graduate tax program at Northeastern University in Boston, where what we work on at Northeastern University is retirement plans. So we've been working with that area for the last 5 years. I received my master's in business administration from the University of South Florida, my law degree from the University of Miami, my master's in law from the University of Denver in the area of taxation. I'm also a member of NAFA, and today we're going to look a lot about what you can do in the area of retirement plans.
And I'm Max Couliette, and you'll see here I'm a CFP, CLU, CHFC, started the business 31 years ago up in Seattle, Washington. I'm president of National Pension Partners. I've been actively involved with NAFA for a number of years now. And between us, we have a mixture of unique experience in qualified plans. Now, here's our disclaimer. I'm going to just let you read that instead of me repeating it. But let's talk first about what's the problem with retirement plans today. First is the need. The need is 80% of pre-retirement income. That you'll see in many, many publications. The savings rate, though, depends upon earnings and the average savings rate and when they start retirement and the rates of return they get on retirement. The real problem, though, is in a recent USA Today article, it stated that the average baby boomer is only saving about 33% of what they should be saving for retirement. Whereas the average earner at 35, who's going to retire at 67, must save 18% a year. And that's assuming a 4% rate of return. And that doesn't count downturns in the market. Comparable for low and high rates are 12 to 22%, but most people don't save enough. And starting early is more powerful than getting just a high rate of return, but most people don't save enough or start early enough.
Yes, and retirement planning has been a real big beef of mine for, let's say, like the last 5 years or so. When I started teaching at the graduate tax program at Northeastern University in Boston, I'm the lead faculty member for retirement plans. So I looked around and said, okay, when are we learning about retirement plans? Do we learn it in an MBA program? Well, I went to the MBA program at South Florida and went through it, and guess what? No retirement plan classes are offered. So obviously you can't learn at the MBA program. So I went to Harvard, one of the nicest MBA programs in the world. But do anybody take a retirement planning class? The answer is no. Why not? It's not offered at the Harvard MBA. Neither is it offered at Stanford or any major school. So then I went on to the law schools, went around all the country to find out, around the United States, does anybody offer a retirement plan class at law school? Couple law schools actually do have them. For the most part, the answer is no. So most lawyers out there never took a basic retirement plan class that you're going to learn today. So now let's take a look at dentists. Do they ever take a retirement planning class? The answer is probably not. It's not offered. Medical doctors, no. So now let's go back and think about when you were in high school. High school, did I go to take a retirement planning class? I don't remember that. I remember algebra. They made me take that. Chemistry, oh boy, that's useful today. Biology, wonderful class. But it wasn't even offered in high school yet. Everybody who's listening to this at some point in time will retire, and they need to know the basics. Oh, I'll go talk to my CPA. They know everything, right? Well, guess what? Most CPAs, because I teach at a graduate tax program course, do not ever take a retirement planning class because it's not offered as part of the CPA curriculum. It's auditing, it's accounting, it's taxes, it's financial management, but business law, but not qualified plans. So what you're going to learn today is an area which is huge. Everybody needs, but unfortunately we have a very little supply.
You know, one of the things I would add to that too is most insurance advisors or financial advisors are going to know more about these plans than the advisors the client typically will go to and seek advice, like the CPA. So it is a problem, this education field. Now, let's talk about the plans themselves. First, let's start with the no administration plans. IRAs is an example. What's an IRA? It's an individual retirement account. It was set up by Congress to motivate people to save for retirement. Because what happened is back in the early 80s and late 70s, they came up with this thing called a 401k and other retirement vehicles to motivate employers to get employees to save money, and employers began eliminating defined benefit plans, which we'll talk about in a few minutes. You also then have, in that IRA, you have the ability to contribute as long as you have income, which takes you up typically to 70.5, at which time you have to take the dreaded RMD, or required minimum distributions, in those plans. Now, the employee or their spouse can also contribute to these plans depending upon their modified adjusted income. And I'm not really going to go back and go through the tables on that, which pretty much tell us about how that phases out over time depending upon a person's income. But in essence, it does eliminate the ability to put away more money the more an individual makes an income. So let's talk now for a few minutes about what some of the limitations are to an IRA. First of all, improper use of an IRA can disqualify the IRA. And there's a lot of things that have happened in the marketplace where people have motivated, quote, self-directed IRAs. Where in a self-directed IRA, they're saying invest in real estate or do these other things. So one thing to understand is borrowing money from an IRA is a prohibited transaction. Using the IRA for security as a loan is a prohibited transaction. Selling property that you own, i.e. gold, the rental property you already own to your IRA, those are all prohibited transactions. Or buying a property, like one client we had bought a duplex. And in that duplex, one side of the duplex, it was in St. George, Utah, he was going to use for his own purposes. But occasionally, because the other side wasn't rented and he had a temporary renter on the other side, so he would flip back and forth. Well, that caused his IRA to be thrown out when he was audited. So people have to be careful with their IRAs, and there's a lot of things going on with that. And there are rules, but they're simpler. They don't require any administration. But now let's talk about SEPs, because a SEP is a written plan. And a SEP allows for each eligible participant to participate in this simplified employee pension plan. It's voluntary contributions, so it's up to the employee to make that contributions. It can be adopted and funded after the year end. So many plans you have to have adopted, and you may have to have them funded in some cases by year end, but you at least have to have it adopted by year end. With a SEP, you can adopt it in January and fund it in March for your tax deduction. Okay, also, it's simple to establish. It's simple to maintain. And there are very minimal reporting rules, which some employers like. And substantial amounts can be contributed to those plans. And you can make contributions versus the IRA after 70.5 if you're still employed and earning an income. So there are some advantages to a SEP plan. Now let's talk for just a minute about simples, because there's a trade-off between a SEP and a simple. You know, with a SEP and a simple both, you have to have all the employees participate that are eligible. And the employer must have, the employees must have immediate access to the contributions, so they're always vested. And it can limit an employer's deferral. And IRA may also have less creditor protection, and that can be a big thing for some of your clients. I've had many doctors that thought that they had more creditor protection in those types of plans as they can. But now let's talk, getting into that That simple plan, and that really stands for Savings Incentive Plan for Employees. Now, it didn't say for employers, did it? Because a lot of these plans really discriminate against the employer or the highly compensated. Now, this is a plan that is funded by voluntary salary deduction by the employees to an employee-owned, in essence, IRA. This is not really a true qualified plan with full creditor protection again, because this is a IRA in essence. So in this case, the employee contributions are excludable from the employee's income, although they are subject to payroll taxes, FICA, FUTA. Now, that can make a big difference when we discuss it later in terms of tax savings for the business owner. And in doing the funding of that kind of a plan, each employee that earns $5,000 in a given year is eligible to participate in that plan. There is no hourly number of hours they have to participate. It is just a matter of compensation and did they work during the year. And you can exclude employees under collective bargaining agreements, but if they earned $5,000, you cannot exclude them. Now, the employer must either make a matching or non-elective contribution each year to the plan. The matching must be an equal amount, if any, that each employee chooses to contribute, up to a maximum of 3% of employee contributions. So what does that mean? Well, again, a highly compensated employer could, in essence, be creating a plan that discriminates against them. Because if you look at the traditional employee that may be earning $30,000 or $40,000 or $50,000 with Social Security combined with a 3% match in a simple plan plus their contribution, they're replacing a higher percentage of their income than is the employer who's earning maybe $200,000 a year. And we'll talk some more about that here too. Or you can make just a non-elective contribution of 2% annually for those employees. So let's talk about, though, some of the other plans that we have available to us as advisors to help our clients with. One of those is defined contribution plans. That's a broad label covering a lot of different plans. Let's talk first about 401k plans. And in 401k plans, that was adopted many years ago to allow for tax deferral and to allow employees to participate in saving for their own retirement. The theory when Congress first adopted this was that this would be in addition to other plans sponsored by the employer, when in reality, what did most employers do? They eliminated the defined benefit plans in favor of the 401k. Because what does the 401k do? It places more of the risk on the employees. So, when you do that, you have to remember that those plans are traditionally distributed by investment advisors. There are group annuity contracts that insurance companies use, and the rules on that can vary by state. In some states, you just need an insurance license to do a group annuity contract, while in other states it may require a securities license. You also have to watch the fact as an insurance advisor that you may reside in a state where it does not require a securities license, but the employer you're working with has employees in a neighboring state that requires a securities license to market those plans. So it can get rather complicated when dealing with that. But the business can deduct the contributions to those plans, but they also cannot discriminate. So they cannot favor the highly compensated. And again, as my partner always talks about, the fact that these plans are the least tax efficient plan that we have available to us because they're still subject to FICA and FUTA. So what you can run into is a circumstance where perhaps other plans may provide an additional $1,500 or more in tax savings in a given year than would a 401k plan, as an example. And there are limits in the 401k that we'll talk about a little later. You also have age-weighted profit-sharing plans. That's a profit-sharing plan that favors the older employee, that allows them to contribute. You'll see those in the marketplace. And typically, the fewer years to retirement, to the targeted retirement date, the more of the greater part of the contribution they're going to receive in that age-weighted profit sharing plan. You're also going to see some things out there like 403Bs. 403Bs are primarily in the nonprofit arena. So you'll see churches, you'll see synagogues, that type of entity that will have those and sponsor those plans. A 457, that's going to be more of a deferred compensation plan in that nonprofit arena. You'll see those out there. You'll also see new comparability profit sharing plans. Now, what are those? Basically, it's a variant of the traditional profit sharing plan in which the employer makes an annual contribution to each employer's account. The contribution, though, is determined by a preset formula, not just based on profits. So the employer, if they're showing a profit, they can declare the profit, and then in the new comparability formulas, the higher paid employers or workers and key employees can create a little better contribution for themselves and minimize the allocation to the rank and file employee. So those are kind of some introductions to the qualified plan marketplace and what we're going to deal with today. You need to know a little bit about these plans to get into some of the other stuff I think you're going to find a little bit meatier that Nick's going to address here in just a minute. Now, when we get into this, there are some limitations in these plans. In the 401k, in 2015, it's $18,000 is your limit. But you do have a catch-up of $6,000. So what does that mean? Well, you take your 18 plus 6, you can get in $24,000 in that plan, but that's the maximum. And again, if it's someone making $200,000 a year, that's not going to replace a very high percentage of their income. Now, if we combine that with the profit sharing plan, we can now get it up to $53,000 for 2015, plus some catch-ups if they're over 50. And that gives them an additional $6,000, so we're now at $59,000. But again, the 401k plan, if you were taking the maximum of $18,000 plus $6,000, you're still subjecting that income to about $1,588, I think is the right math, in FICA and FUTA taxes that you wouldn't have to do using a profit sharing plan or other plans we're going to talk about here in a minute. But these are rules that you have to be pretty familiar with. Now, we're going to talk now about fully insured defined benefit plans, or 412E3s, and I'm going to let Nick come up and talk about that.
We got to listen to Max talk a lot about the defined contribution plans, and frankly, plans we're most familiar with, like the 401k plan, the SEP plan, the Simple plan, and the IRAs. And there are quite a few other plans that are out there that you can do, from 457s to 409 Cap A's. So the world of retirement plans is absolutely huge, and it's actually fantastic because it's a world of opportunity. But the opportunity that we have today is defined benefit plans. And most people say, wait, I don't know anything about defined benefit plans. I do life insurance. Well, if anybody out there sell a whole life policy or know what a whole life policy is, if you'd raise your hands. Well, I see quite a few people raising their hands, of course. You've sold a whole life policy. Now, how many people out there have sold a fixed annuity? Raise your hands. Everybody raise their hands. You've done a fixed annuity. Guess what? You've basically put the parts together for a pension plan. So just basically how it works. Imagine if you went to see your client, I'm going to sell them a whole life policy, $10,000 a year going into the whole life policy. Guess what? It's not tax deductible. Then I go to client B. I'm going to sell them an annuity. They're going to put $10,000 a year into annuity. Guess what? It's not tax deductible because of this code section called 264 doesn't let you deduct it. But now let's imagine this. We set up a plan document. It's called a pension plan or a trust. And maybe you're familiar with that because we use it in estate planning. And then the trust goes out and buys a whole life policy, 50%, and an annuity, 50% goes into annuity, and now all of a sudden it's tax deductible. So you're right in line with selling a pension plan. I mean, that is a pension plan. And what I tell people to do, go look at the values of your life insurance contract and annuity contract at age 65. They're staggeringly high. That's where your benefits come from. So we're really close to doing a pension plan. The problem is we never got a course in pensions. And the reason why, we all know now today, it's not offered, except through NAIFA. We're going to offer you a pension course for the first time. I mean, it's just like this area's been around for years. And we'll get into the history of this. We'll get into the different parts of it, and we're going to simplify it. Now, I go to a lot of other tax conferences across the country. And when you listen to the tax speaker, they make it hugely complicated. No one understands all these crazy code sections. And it doesn't need to be that complicated. It can be really simple. I think Occam's razor says simplest is best. If you can find the simplest solution to your problem, that's probably the best solution to the problem. So let's take a look at defined benefit plans in general. And there are four major types. First is the 414X. And that would confuse anybody. If I was here to confuse people, we'd talk about 414X, otherwise known as a DBK. Now, the DBK was actually placed into the code in 2006, effective in 2010. So it exists today. There are rulings about it. But we looked at this back in 2006, because I've been practicing tax law for 30 years. So obviously in 2006, I'd pulled out PPA 2006 and I read it. And I said, this thing's going to get no traction. In other words, no one's going to do this. What it was, a combination of a defined benefit plan with a 401k feature in one plan document. That's all it was. Yet it's one of the four different types of retirement plans in pensions. So it can be as complicated as you want. I can promise you, you can go look at the 414X rules. It is voluminous. It's extremely complicated. Yet it's practically useless, which is typical things you find in the Internal Revenue Code. So when we scroll through the next section, we come through 412E3, otherwise known as fully insured plans. Now, somebody may have said, well, I heard of these are 412I and they're bad. No, there's nothing bad about it. It's a code section, for crying out loud. What does the code section say? Read it. Here's what 412E3 says. It says, if you fund your pension plan with guaranteed insurance and guaranteed annuity contracts, actually the language actually says you're funding to guarantees at normal retirement age, then you're outside of Section 430. Now, then you go, oh, but I don't know what 430 is. 430 means it's a traditional defined benefit plan. If you see how the tax geeks speak, they always say, well, it's outside of another section, and unless you go read the other section, you don't know what they're talking about. So you have to read the other section. When you read it, you go, oh, I see what they're talking about. We're out of the minimum funding standards under Section 430. We're not a traditional defined benefit plan. We are a defined benefit plan. We're fully insured. And the reason you can do this magic of fully insured plans, is we're running all our numbers on the guaranteed rates of the insurance contract and guaranteed rates of the annuity, projecting out to age 65. Or if you're older than 65, you can fund it for 5 years. Fund for those 5 years if you're age 70. And those guaranteed cash values are your retirement benefits. So now you know what a fully insured plan is. It's a whole life policy with an annuity. This is not rocket science. I can promise you that. Now, a lot of the TPAs and the speakers will try to make, oh, yes, it's complicated, it's difficult. And I've even seen TPAs, oh, it's illegal. Wrong, wrong, and wrong. Okay? It isn't. It's not illegal. It's not that complicated. Frankly, if you work in the area of pensions, it's a very, I call it safe harbor pension. You're running it in safe mode. It's like a computer running in safe mode. If you move into traditional, it can be a lot more complicated. No question about it. Well, I heard, we always hear things, right? I heard there's cash balance plans. Everybody should have them. There's always a buzzword out today, and it's now cash balance. Should everybody have them? No. Why not? Well, because cash balance plans are really based on funding a traditional plan, but the interest rate is being earned at a hypothetical rate, and everybody gets their balance hypothetically that's in the account. It has nothing to do really with it's great or bad. What happened was large companies didn't want to pay the ever-increasing pension cost as people's salaries went up, because most traditional plans are based on your salary. So they said, how can we stop this? Oh, we'll create this cash balance. They're going to get what's in their account, regardless of their salary, earning a hypothetical interest rate. That, in a nutshell, is cash balance. Now, are these plans bad? The answer is no. If somebody says, oh, well, he just wants fully insured plans. They just want cash balance. No, it differs on a case-by-case basis. If you told me I've got a group of 30,000 employees and they're interested in a pension, we may want to look at a cash balance plan for them, not a fully insured plan. Because with 30,000 employees, you can afford the actual cost it takes to set up a cash balance plan and maintain it. It's like a big mainframe. I mean, seriously. In other words, like if you went to United Airlines and say, I got a computer system for you, it's a PC. United Airlines can't do with a PC. They need huge computers to operate their department and huge software programs. But if you go to a doctor and you say, hey, I got this big, huge mainframe I'm going to install into your system, they don't need it. They need a PC. And when you're working in fully insured plans, I promise you, you're working with PCs. You're working small, safe mode plans. So now what level before you should look at cash balance or traditional? I say usually about $1 million annual contributions. So if somebody comes to me and said, look, we got a client we wants to put $1 million a year, or his company's going to put $1 million a year into a pension plan plus. Then I'm looking at cash balance or traditional. If you have a client, well, I'm going to put $250,000 a year into it. No, you do a fully insured plan. Keep it simple. Get yourself out of all these rules and requirements we're going to look at today that you would be faced with if you're in a traditional defined benefit. Now, traditional defined benefit plans, what's the difference between them, cash balance? Again, the assets are invested in the marketplace in traditional plans. So in the stock market, it goes only one way, up, right? No, it goes up and goes down, goes up and goes down. We saw that in 2008. The market went down 37%. And did I get phone calls from my clients? What's happening to our pension? Well, I got no phone calls from most of my clients. Why? 98% of our clients were in fully insured, and our plans went up 3%. It doesn't go up great, but it goes up when it goes up. But it didn't crash. And I said, we have all our money. Yeah, it's still there. It's in the pension plan. I had 2 clients that were in traditional plans. One lost $250,000, one lost $37,000. What do we do? I said, well, you lost a lot of money. You need to either replace it or you're going to get a bill from the service, the IRS. You know your friends at the service? Hi, I'm here from the IRS. You had a bad day. I'm here to help you. Here's a penalty. And do you know what? They sent him a penalty. They sent him the one client a penalty, the $37,000 loss. It came in. I remember seeing it. $3,700 you owe us. I just had a bad day. I lost money. I owe you. And then this was a neurology group of all people. They lost $250,000 in their pension. Remember, the market was down 37%. They got a bill from $25,000. Now, what do you think most doctors and businessmen do when they see a bill like that from the service? They tend to go, this can't be real. And they ignored it. Seriously, this is what happened. And this is what Max was talking about, these penalties. If you don't do the right thing, they sent them another bill. One got a bill for $37,500. And the reason why you lost $37,000 in your plan, you owe the IRS $37,000. The other, the neurology group, got a bill of $250,000. Okay, if you lose money in a pension, as I tell my clients, it is not good. You're going to get hit with these excise taxes from our friends at the service because your pension has to guarantee the benefits at normal retirement age. If you lose money and you're the plan sponsor, you need to make up the difference. Now let's go take a look at a whole life contract or a fixed annuity. If you put money into a whole life contract, you did it for 10 years, how much did you lose? You didn't lose any. Why not? Because they have a minimal guarantee that goes up every year for the next 10 years. Okay, let's take a look at a fixed annuity. You put money in a fixed annuity for 10 years. Did you lose money? The market went down 37%? No, you didn't, because it's guaranteed for the next 10 years. You have a fixed guaranteed rate or a crediting rate, whichever is greater. So now you have a guaranteed product, which we had most of our pensions in back in 2008 when the market collapsed. And guess what? They all earned 3%. It was not an issue. So everybody here has the potential to do a pension plan. The problem that I've seen, and it just doesn't have to do with NAIFA people, like I'm telling you it has to do with MBAs, JDs, MDDDS, is there's just no education in this market space. And I agree with Max. If you're a CFP, you actually take a retirement planning class. Many people that get CLUs, they take retirement plan classes. But in the general public, that's not even offered. Now, Max went over this earlier. We call it the COLA adjustments. I remember seeing this when I took my first pension class. When was it? Back in 1982 or 83. Okay, and I was going, what are all these numbers? What do they mean? And they come out every year. Now, the beauty of pensions is this. The rules are going to change every year. The clients need updated every year. The plans need to get updated every year. They tweak the rules, and they need somebody on top of it. Now, I did an analysis to find out how many people are lawyers, like myself. Okay, there's about 1,200,000 attorneys in the United States right now, 1.2 million. How many doctors? 800,000 doctors. How many people have passed the CFP? 70,000. How many total financial professionals? 219,000. Now, how many people have passed the enrolled actuary exam that can certify pension plans? And how many people work in the benefits area, which has 18.9 trillion, not billion, trillion in assets? Try about 4,000 to 15,000 people. That's it. So we have 4,000 to 15,000 people basically supporting an industry that has nearly 20 trillion in assets. Now, the reason they don't do it is quite clear, is they make this stuff enormously complicated. My job, or mission, as people say, that I decide to accept, is to get rid of all this complexity and make it simple. Keep it simple, S. Okay? And if you keep it simple, then it starts making sense to you. Now, the first thing Max went over is, what can you do in a 401k? You can put money in what they call elective deferrals. In our other presentations, which I'll invite you to go to, is you'll see the problem with this that you have an advantage of. Because the elective deferrals, you all pay Social Security and Medicare tax on, okay, which is 15.3%. In a pension, you eliminate that tax. But most people don't even know that their 401ks are loaded with a 15.3% load. If they moved over to a pension, there is no load. We'll get into that later on in some of our programs. But you can put in up to $18,000, 100% of your salary, actually up to $18,000. Catch up is $6,000. So you can literally today put away about $24,000. Now next year we know what will happen. They'll change the rules. They'll update these COLA adjustments. This is for 2015. 2016 there'll be different. The annual benefit of defined benefit plan. Now most people don't find this exciting, except actuaries. Now why do actuaries find numbers exciting? Because it means something to them. When I looked at it years ago, it was called the maximum considered compensation under ERISA for defined benefit purposes, and that's how it was explained to me. And when they explain to you like that, you go, I don't know why I'm learning this. So I'm going to explain to you in English what it really means. The annual benefit. Okay. When you design a plan, you can fund money into a plan that can give you a guaranteed lifetime income of your salary up to a maximum guaranteed lifetime income of $210,000 a year for the rest of your life. So if I put money in today, I can put enough money in so by the time I'm age 65, I have a lump sum that's huge enough that gives me $210,000 a year. What does that lump sum have to be? Now, according to the GAO, which just got published by the General Accounting Office, it's $3.4 million. So I have, for everybody in this room, $3.4 million in available deductions if they're willing to fund their retirement plan. Well, it may not mean much to me, I'm making $40,000, $50,000 a year, I can't fund it anymore. But let me tell you about your physician clients. It means a lot to them. The veterinarians, the pharmacists. Wait a minute, I thought I could only put away $24,000. That's in the defined contribution plan. Defined, or 401k. Defined benefit plans, you can put away $100,000, $200,000, $300,000, because I can promise you, with a low interest rate environment today, you need a lot of money in your plan to give you a guaranteed benefit of $210,000 a year for the rest of your life. And that's what it means in English. So it's a little different from, like I said, when I took the class and they go, what's the maximum considered compensation under ERISA for benefits purposes? Doesn't mean anything to you. Now it means something to you. You can get a big lifetime income using a DB plan. Annual contribution for a defined contribution plan, that's a little different. That's $53,000. It's a flat stated amount. Unfortunately, to determine how much I need to fund today, they'll guarantee me a lifetime income of $210,000. We need age, length of service, interest, mortality assumptions. In other words, it has to be calculated. Okay, but the annual contribution to a defined contribution plan, it's easy. It's $53,000. That's it. That's the max. So in a defined contribution, you'll never go over 53. You can't put away 100, 200, 300, which you can in a defined benefit plan. Now, of course, ERISA has to be more complicated than that. If it was simple, I tell people if it's simple, everybody would do it, right? Okay, so it's got to be complicated. So they've got another maximum considered compensation. 2 rules. One is for testing purposes. It's $265,000. Doesn't mean much to you, but does to an enrolled actuary. What it really means actuarially is if I have a doctor with a bunch of employees and the doctor's making more than $265,000, I can actually reduce the employee contribution if they're in the defined benefit plan with them about 20%. Seriously. It's a testing rule that's out there, and that's basically what it means in English. So if I'm looking at a physician or a highly compensated individual and they want to set their salary at the optimal amount for them and the lowest for their employees, you set your salary at $265. If you have no employees, you set your salary at $210. And most of the business owners and physicians that own their own practice can set their salary, and these are magic numbers you want to use. Definition of HCE. I remember looking at this years ago and going, what does this mean, highly comp? It means a lot. It means this. If you're making more than $120,000, let's say you're an engineering firm, you have a lot of employees making more than $120,000, there's no non-discrimination testing. What does that mean? I can put in a lot for me, small for them. And I pass. In other words, I want to put away $100,000 for me, but I don't want to give my employee anything. I'm going to give them $1,000 a year. And still pass non-discrimination because there's no non-discrimination testing if that employee is categorized as a highly comp. Now, we use it for other testing purposes also as well, so it's a very important definition. Social Security wage base. Now, all the CPAs know this, is $118,500. Okay, what does that mean? Once you make above $118,500, you don't pay Social Security taxes anymore. It disappears. So once you go above the wage base, it disappears. It's another magic number. And I think everybody, even at high school, should know this, what I call fairly basic education. Because most people think, well, I pay Social Security taxes. I see they take out 6.2, but they don't realize the employer matched it. So it's really 12.4. Hello. Okay, 12.4% of every dollar earned is take out in Social Security taxes from everybody who works in the United States until you make more than $118,500, and that tax is then removed. Kind of a big secret here, but it's not. It's just the way the rules work. Okay, let's take a look now at some federal income tax considerations. Why do people do pension plans? Here's the number one reason I can tell you after doing over 450 of these plans across the country. The employer contributions are deductible. They are looking for tax deductions. How do I get a deduction? Now, we know people say, well, I can go buy equipment, all right? And I've done that in my own company. I go buy a computer, but guess what? It depreciates fast, and you're not going to retire off it. Well, I could buy, tractors and things like that. It depreciates fast. It goes down in value fast. But one of the main reasons people buy pensions is all the contributions that are deductible, from federal income taxes, state income taxes, Social Security taxes, Medicare taxes, and Obamacare taxes, all gone, as the money goes into the plan. So they go for the tax deduction, but I'll also tell you something in practice after doing this for 10 years. Actually, more than 10 years. Since 2001, I guess it's close to 14 years. After they start doing this for a while, they realize their account is building up to a huge value. Then I get a phone call, ring, when can I retire? Okay? And what's in my account? And all of a sudden they find out they have a lot of money in their account because they didn't have to pay all these taxes, and it just keeps growing, also on a tax-deferred basis, and if it's a fully insured plan, on a guaranteed basis. So we can tell them what it is, and we can also tell them what they're going to have when they go to retire. They like the employer contributions that are deductible, but actually they love the fact they have money in a secured place, the insurance and annuity contracts. Now, if they want to gamble in the market, and everybody likes to gamble, otherwise Las Vegas wouldn't be the fastest growing city in the country, right? They can still have their 401k and put their fund money there too. That's the thing you talk about in the club. Oh, I had, this science and technology fund. It's up 99%. And I analyzed one. It did go up 99%. Whoa. Guess what happened next year? It went down 99%. The same fund. I couldn't believe it. I was going, science technologists took a bath. Now, that's what you talk about in the club. Okay, how much money you made in your 401k. What you talk to your spouse about is the guaranteed money you're going to have from your pension plan at retirement. That's what they're interested in listening to. And you have the products to do it. It's the whole life and the annuity contracts, except you just got to wrap it in a pension and put it in there and deduct it. Now, of course, there's a lot of rules, so I'm making it a little bit overly simplified, but you have to go through the rules, and you'll get the result your client wants. So, employee deferrals are also excluded from income. The accounts can grow tax deferred. It will be taxable once distributed. Now, we do know that's one of the disadvantages. And some people say, well, you should just do it this way because, you got to pay taxes on it. Really? Well, there's some taxes that completely disappear. Remember the Social Security and Obamacare tax? goodbye. Medicare taxes, goodbye. Now, the taxes that you will pick up is the federal income tax. In many cases, you won't even pick up the state income tax. You'll pick up the federal income tax when you retire. But you know what people do in practice? They roll the funds to the IRA and they continue to defer until April 1st after they turn age 70 and a half. Now, notice the rule. It could be April 15th, we would all remember it, right? It could be age 70, but that would be too easy to remember, right? So the IRS in their infinite wisdom, or Congress, has to put a rule that's April 1st, the year after you turn age 70 and a half, so we'd all forget it. And then you have to take out what they call required minimum distributions. So the fact is you can defer for quite some time before you're forced to take out part of the account, usually it's 1/16 the value of the account, on an annual basis, pay taxes on it, live off it. By that time, you're generally in a lower marginal tax bracket. We've done the analysis. You're pulling off at a 39.6 and getting down to a 15 to maybe 17% bracket or less. So you had a huge savings as you're pulling the money out when you go to retire. 72T penalty is increased to 25%. Now that takes place on certain IRAs. Small employer tax credit and employee saver tax credit, those are things that we can use, but it's not really very germane to what we're doing today. But what is germane is understanding fully insured pensions. First of all, we got to go back to 1921. In 1921, this is when these things really got started. MetLife actually came out with a group annuity to fund retirement benefits. And what happened afterwards, actually, Equitable came out shortly thereafter. So the insurance industry has been in pensions since the 1920s. Well, what happened? Well, what happened was back in the 1980s, they changed the rule around TRA 86, TAMRA 1988, and OBRA 1989. And remember that 210,000? They basically cut it in half and then some. And what happened? All the insurance guys left the pension industry. If you've been doing insurance work in the 70s and the 60s, like a lot of our enrolled actuaries had, if you were in the insurance business, you were in the pension business. But then what took place is the 80s, the 90s, and the 2000s, all these people retired, or frankly, they passed on. So we lost a huge block of education in the insurance industry that used to be in the pension industry back in the 60s and the 70s. Now, the annuity is funded and then provides lifetime income guaranteed by a major insurance company. But as I said before, the annuity by itself is not deductible. You have to create this trust and have the trust buy the annuity for the participant, and all of a sudden you get a tax deduction. And of course, you have to follow all the rules under what they call 401A, which is the Internal Revenue Code section. Okay, now what does a whole life contract do for your client? The whole life contract provides death benefits. And what are these death benefits designed to do? We have to go back to the old pension rules. It's called a QPSA. QPSA, we've all heard of it, right? No, never heard of it. What's that? Qualified Pre-Retirement Survivor Annuity. In pension geek speak, there is no death benefit. It's a QPSA. And then we all ask each other, was the QPSA funded or not? What does that mean? Do they have death benefits in the plan or not? If you have death benefits, the QPSA, otherwise known as Qualified Pre-Retirement Survivor Annuity, is designed to pay a guaranteed lifetime income to the surviving spouse. It was written back in 1974. And if you think about it, remember, we'll go back to our doctor client. You know, he's making $300,000-400,000 a year, he dies. Okay, big problem, right? Okay, especially for the survivors. What are they going to live off of? Nothing. How much do they need to live off of? Well, the GAO did the calculation. They need $3.4 million today to replace the $210,000. Do you have $3 million in life insurance? No. Do you have $3.4 million in the plan, the fully insured plan? You should, because that would replace the $210,000 lifetime income, and it's also known as the QPSA. So that's one reason you use insurance, is to replace the lifetime income, and that's what was designed in 1974 for. Now, the whole life contract does something else, which is one reason in fully insured plans you can only use whole life and guaranteed fixed annuities. It provides cash value for retirement. Go look at your whole life contract over a period of years. By the time it's age 65, you have a huge amount of cash value in it. Now, that is used along with the annuity, assuming that they retire at age 65, to provide a lifetime income for the participant who's in the plan. And the cash value of your life contracts can be converted to lifetime income. Most people never read the insurance contract, but if you go read it, at the back of your life contract will actually tell you, in actuarial speak, what your lifetime income will be. It's in every insurance contract in the country. But again, purchasing whole life contracts by themselves without through a pension trust is not deductible, and they have that code section that keeps sticking us, 264 of the Internal Revenue Code. So how do you make it deductible? Create the pension trust. Have the pension trust be the owner of the annuity contract, owner of the life contract, and you be the beneficiary. And I can promise you pension trusts are done all over the United States. I mean, there's literally tens of thousands of them out there. Now that the pension trust is the owner of the life insurance contract and the annuity, and you follow the other rules of ERISA, there's all these rules that Max went over before, who's eligible, who can participate, what's the minimal and maximum that you can put in. Then you get your client where they want to go is they get a tax deduction from $1. No Social Security, no Medicare, no Obamacare tax, no federal, no state income taxes. And the reason that is placed in the Internal Revenue Code is this is how Congress is trying to encourage people to save for retirement. And it's a great idea. The problem is there's no classes that teaches them how it works. It's like saying, well, I've got this program, I got this computer, but there's no computer courses to take. And so this is what's going on out there. In a way, it's kind of interesting. So let's go take a look at the rules of ERISA. Now, the rules of ERISA relating to pensions are very similar to 401ks. So if you've ever done a 401k plan, set up a 401k plan for your client, you've had to follow the basic ERISA rules that we'd have to follow in a pension plan. Eligibility. Remember, you're signing up for your doctor. They always ask, when do I have to bring my employees in the plan? Well, you have to follow the eligibility rules, and they're uniform today. Have they worked there for a year? Yes. Have they worked for more than 1,000 hours? Yes. Now they're eligible to participate in the pension plan. Really? Yeah, that's basically how it works. What about vesting? Some of them don't even know what the vesting rules are. Max and I had to go over that with a client the other day. Just because you put money in the plan doesn't mean they get the money. What happens if they quit next year? They could be 0% vested. All the money's returned back to the plan. Generally, they have to stay 6 years before they can get the money. Yeah, you just can't quit. It's the golden handcuffs. Engineers should love this, okay? I've told the people that we work in Silicon Valley, I said, you really want to do this. And I've had practical experience. Why? Your engineers aren't going to leave for at least 6 years. I've even seen presidents of banks not leave because they waited for their 6 years to be vested fully in their pension plans. It goes 0, 20, 40, 60, 80, 100. And you're 100% vested after 6 years. And that's a common rule in ERISA. When it relates to pensions, it also relates into profit-sharing plan section of your 401k. Non-discrimination issues, toughest area in ERISA. A lot of people say, well, if I got to set up a pension plan for me, I got to bring all my employees in. The answer is no, you don't. What's the rule? You only need to bring 40% of your employees into the plan. Okay, so I had Dr. A with Dr. B, and he had like 6 employees. And they said, well, I got to bring 40%. That means I have to bring some of my employees in. I said, have you thought about hiring your spouses? Do you know they all never thought of it? Oh, they do some work, but I just never put them on payroll. Put them on payroll. They'll count for part of that 40% rule. So the 2 doctors go in with the 2 spouses. They go into the pension. The other employees do have to participate in another plan. It's usually a 401k profit sharing plan. They call that cross-tested plans. New comparability plans. It goes under different names, DBDC combination. It is the hottest thing, and has been, in the actuarial community since 2001 when the regulation came out by our friends at the Internal Revenue Service supporting these cross-tested plans. They put out new cross-tested regulations. So all the 4,000 people that are enrolled actuaries know this. So I'm talking to enrolled actuaries, oh yeah, of course, cross-tested regs, they came out in 2001, everybody knows that. But what about the 1.2 million lawyers? They never got the memo on the cross-tested plan. What about the 800,000 doctors? Is that a latest drug, cross-testing? They don't know anything about it. You know, so what you have is you have this, what I call this supply-demand mismatch in the industry. What about the 300 million people in the United States and the 90 million people that work? Do they know about cross-tested plans? No, they don't. Yet, the 4,000 enrolled actuaries, they all do. Because, like I said, it's the hottest thing in the enrolled actuary community. Now, can you do that? Sure, you set up your defined benefit plan, fund it with insurance and annuity contracts, qualify it under 412E3, and then set up the 401k profit sharing plan for the other employees, and then cross-test for non-discriminations in forms of benefits. Pretty simple things to do. Now, here's one beauty about fully insured plans. There's only two types of investments allowed. Here they are. A fixed or equity index annuity. And the equity index annuity has to have certain guarantees and be unisex because of Arizona versus Norse. We've been down that road before. Okay. And a whole life contract. That's it. Well, one client came to us, I want Vanguard funds or whatever mutual funds. You can't put those in the plan. These are the only two allowed. And the reason, there's always rules and a reason behind it. These instruments have guarantees now all the way to normal retirement age. Okay, where if you put money in a stock, let's say you invested some really good stocks out there, General Motors, Radio Shack, I mean, they're really good, right? What happened to them? What about anybody here of Enron? How'd that stock go? It was like one of the top 100 last time I looked at it. Out of business. You know, MCI WorldCom, remember that? I had one client that had 30 million MCI WorldCom. And we told him, hey, you heard about diversification? I don't believe in diversification. Look, I got 30 million. Well, now he has nothing. I mean, so the problem with the market, and there's nothing wrong with, like I said, your gambling money goes in your 401k, is that all these instruments have no guarantees. And you have no guaranteed retirement. So I had I always have these stock people up there who said, okay, I'll tell you what. Put this money in the stock, since you love your stock portfolio, put this money in your stock portfolio, okay? We'll do that as long as you guarantee 3% forever. And I had no takers. Seriously. I said, well, all you have to do, I think my client has no problem buying the stock as long as you guarantee at least 3% minimum floor for the rest of the life, no takers. So it's interesting to see how sharp they are in doing their betas and their alphas and their calculations. And I said, if you can guarantee me 4%, oh, I earn 12% every year. There's some radio jock going saying, oh, you get 12% in the market every year. Sure, guarantee me 4. If you can guarantee me 4, I can probably get you 400 million tomorrow. Seriously. Oh, I can't do that. By the way, the 4 has to be guaranteed forever. Okay? Well, I can't do that. Well, then you're not playing the game, which is guaranteed benefits at normal retirement age. That's what a pension says. It doesn't say, well, maybe the money's going to be there, maybe it's not. Guaranteed benefits at normal retirement age. Okay, so both of these have to be eligible to be used in a qualified plan. No security license needed. The contracts have to be guaranteed, which are all fixed products. No securities go in the plan. By the way, if you put a security in the plan, you'll disqualify it as a 412E3 immediately. Boom. Well, look, he's got a lot of annuities. He's got all these fixed annuities. He's got all these guaranteed whole life. Can't we put like 10% in, this international fund? It'll immediately disqualify the plan and make it either a traditional plan or actually take us out of compliance. Seriously. So you have to be very careful. These are finely tuned instruments, and you can easily mess them up by just investing in the wrong thing, which would be something like that. So remember, the plan is funded with an annuity, fixed or index. By the way, the annuity is the predominant asset that goes in the plan. Life insurance has to be an incidental benefit. And that's what it says in the Internal Revenue Code. The problem is when they say things like that, what is an incidental benefit? Good question. Okay. Now, the incidental benefit rule is easy. No more than 50% can be in the whole life contract. So, and then there's 100 times monthly earning rule. So there's some rules out there. What is a fully insured plan? A fully insured defined benefit plan, otherwise known as a 412E3 plan, is a tax qualified plan, like any other qualified plan, like your 401k or your profit sharing plan. The difference is the pension has to guarantee the benefits, lifetime income, lump sum, and it has to be guaranteed by a major domestic insurance company. Many of these plans are also covered by the Pension Benefit Guarantee Corporation. But then again, some of these plans are not covered by the Pension Benefit Guarantee Corporation. Which ones aren't? Well, you have to go look at ERISA. If you look at ERISA, section 4021, subsection 13, it says this. If your plan is sponsored by a professional service provider with less than 25 employees, you will not be covered under the PBGC. So then, who guarantees your benefits? The plan sponsor and also the state insurance guarantee corporations. So you have to really look to the strength of the insurance company and the plan sponsor to guarantee the benefits, because the PBGC will not be there for you. Now, we talked about Section 430, okay? And Section 412E3 says you're out of Section 430, so you don't need to know that. But what is this section? This is the section that tells you what the rules are for traditional plans, the minimum funding rules, they call it. And it's quite complicated, and there's a lot of hoops you have to jump through to satisfy Section 430. If you move your plan into an additional defined benefit, you have to satisfy Section 430. You must have an enrolled actuary sign the Schedule B on the 5500. You must hire an enrolled actuary, which means the CPA can't do a pension. Now, think about that. You're a CPA, and you do taxes, right? And the first thing we have is a defined benefit plan, traditional. Guess what? The CPA firm can't sign the schedules for you. You need to have an enrolled actuary, one of those 4,000 people I talked about. Let's say you're a tax law firm. I'm the biggest tax law firm in the country. First thing I ask, do you have an enrolled actuary? No. That means you cannot certify the plan. You have to have an enrolled actuary. Again, these are rules under Erisa, which is one reason CPA firms and law firms, they just basically don't set up pension plans, because most people are not enrolled actuaries. Now, here's a very important part of this presentation. As they say, look at me, I'm the captain now. Look at the 401k plan, okay? Here's the difference. Is a pension plan more tax efficient than a 401k plan? The answer is yes. What? Why? Why is it? If you fund your 401k plan with $18,000, the money has to, as one federal judge said, follow the money. The money goes from the company to you as salary. And you have to take out 15.3%, like no kidding, in Social Security and Medicare taxes. Then you get to put it into your 401k. If you fund your pension, the money goes from the company to the plan, and you pay no Social Security or Medicare tax. You save $2,754. Now, in my humble opinion, everybody should know this. Okay, but I can tell you, going back to 2001, when I started doing pension work, and I was working with the enrolled actuaries, and they came to me, and they go, well, you know the pension is more tax efficient than 401k. I said, what are you talking about? They're both qualified plans. I said, no, you don't understand, Nick. In a 401k plan, you have to take it to yourself as salary, and you're going to be hit with 15.3% Social Security and Medicare tax before you can put it in your 401k. Seriously. If you go from here to your pension, you don't pay the tax. You save 15.3%. I said, you're kidding me. And I went back, I did the research. I said, they're right. So guess what our enrolled actuaries had us set up? We didn't have a 401k. We had a pension plan. Okay? We had a qualified plan because they wanted to save the 15.3%. However, today most people have 401ks. I understand that. Okay? But for different reasons. It has nothing to do with the tax efficiency of the plan. Let's go take a look at the incidental benefit rules. Incidental benefit rules, people say, well, I'll just put everything in life insurance. You cannot do that. There's a rule called 74307. It's been around since 1974. That's the reason it's called 74307. Whenever you see a revenue rule and you see a number in front of it, that's the year it was created. And it said this: your death benefit can be no larger than 100 times monthly earnings at normal retirement age. Well, what's that? Well, it changes every year. Because remember, right now it's $210,000 a year for the rest of your life. Last year it was $205,000, and you have to calculate that. Or no more than 50% of the annual contribution in an insurance policy, and then 50% in annuity. Now, there's also a letter called the Schultz Letter that everybody knows about, that you can go up to 66 2/3 on certain high cash value products. Now, many people have never heard of the Schultz Letter. That was a letter actually written from the IRS to Phoenix Home Life, allowing a high cash value products to go up to 66 2/3. And anything that's below that is considered incidental benefits by our friends at the Internal Revenue Code, Internal Revenue Service. So you want to stay under the incidental benefit rule if you're going to fund with insurance contracts along with annuity contracts. I heard these plans are complicated. Is that true? And the answer is yes, they are complicated. Sometimes I tell people Erisa is complicated and built to stay that way. Every year they'll change the rules and they change it continuously. I mean, it is amazing how complicated it is and how they continually change the rules, which is one reason. And even when I did estate planning work years ago and I came across a pension, they said you need to work with a third-party administrator. And I agree to that today. So if you're going into this and you decide, yeah, I'd like to do some pensions, you need to work with other parties. Matter of fact, in our company, we actually take our plan designs and our analysis, we pass it around so a lot of people get to take a look at it to improve the quality of the design or what we're doing out to the client. So if you're a lone wolf insurance agent, and there are some out there, I work by myself, I don't like other people, you don't want to be in the pension business because you're going to be working with enrolled actuaries, tax attorneys, the CPA firms who are the best people to work with in this. They don't know much about pensions, and certainly they could offer it to their clients. It's a team effect. It's not a one-person effect. By the way, the rules are so complicated, even the IRS has recognized it. And they have correction programs called EPCRS. We're not going to spend much time with EPCRS because you can literally take a whole course in EPCRS. It's called the Employee Plan Compliance Resolution System. It allows you, if you find a plan, it's out of compliance. You, in many cases, can self-correct the plan, bring the plan back into compliance. You don't even need to notify the IRS. And then there's some that, wow, this is really out of compliance. Then you have to actually work with the IRS, and they have various different types of programs. You pay them a fee, you work with them, and you get the plan back into compliance. So they do recognize they are complicated. The plans go out of compliance, but in many cases, you can push them into compliance through the self-correction program. Now, some of these plans are also funded with PBGC insurance. If you're a fully insured plan, the rate is like $41 per participant. If you're a traditional plan, it could be $700, $800, $900 per participant. So like I said, the minute you push over to traditional plans or cash balance, I tell the plan sponsor, get ready to write some large checks, the ones you're not used to, because the compliance rules are a lot stronger and more stringent than they are in a fully insured plan. So why are 401ks more popular? We talked about the tax efficiency. Why didn't anybody have pensions? Why do they have 401k? So the federal judge said, follow the money. Where does the 401k contributions come from? The employees. They make the contribution. Where does the pension money come from? The employer. They make the contribution. So from the employer standpoint, which is it better for them to have? The 401k plan where the employees take their salary and fund it, or a pension plan where it actually has to come from the company's profits? The 401k plan. So as companies get larger, they tend to like the 401k because they go, well, it's the employee's problem. They get to fund their retirement. As the companies are smaller and the business owner owns the company and is the employee, they tend to like pension plans because all they're doing if they don't have a pension is they're just paying extra Social Security and Medicare taxes they don't have to pay in many cases. Okay. Now, why is the other reason 401k plan's popular? Well, if the stock market goes up more than 15.3%, the loss is mitigated. So if the stock market keeps going up at high rates, it's mitigated. What happens the year it went down 37%? Now, let's not think about that, okay, because the market could just crash. Well, if you think what you did, you took money from your company, you moved it to your 401k, you paid 15.3% in Social Security Medicare taxes, and it went down 37%. You took probably a 40 to 50% bath, seriously, not realizing about that extra 15.3. I can tell you every business owner that's listening to this understands the 15.3% tax. So how much can I fund in this pension plan? Now, some of the plans we have per participant, they'll have 100, 200, or even 300,000 a year. I wrote an article for the Journal of Accountancy on this issue. I said, well, you can put 300,000 a year. We got to do a fact check. They have peer review. They went out and reviewed it and they said, you're right, you could. Okay, yes. You can put 300,000 a year in these plans and deduct it. I mean, it's just the way it is. It's actually actuarially calculated based on age, length of service, compensation, with minimum maximums in there, and the amount to replace $210,000 a year for the rest of your life. Again, it should be done. Again, you have to work with a team, the enrolled actuaries, to do the calculation. Under PPA 2006, can I have a 401k as well? Yeah. If you want a 401k with your pension, fine, there's no problem. Why did Congress allow that? Again, they're putting in the code encouragement for you to save for retirement. It's all there. You just have to take advantage of it and know the rules. Well, the problem is A lot of people, they just don't know the rules. Like I said, the manual didn't go with the computer program that just went out in 2001 and 2006. Now, here's one very important topic for attorneys that are listening: the asset protection benefits. Like, no kidding. Now, who took advantage of this? There's a guy named O.J. Simpson. You probably remember him. He was driving around this little Jeep. They caught him and he got off, but he was actually convicted civilly and had a $35 million judgment placed against him. But he still lived pretty good because his NFL pension paid him $25,000 a month, and they couldn't touch it. Pension plans are exempt from lawsuits and creditor claims under federal law. Now, the section is called 541 of the Bankruptcy Code. It's actually the Bankruptcy Restructuring Act of 2005, exempting pension plans, profit-sharing plans as well, from creditor claims. Okay, and of course there's a law firm in Utah who has actually trademarked the 541 Trust as being one of the best asset protection vehicles out there, and they're correct. And the reason they're correct is we have a federal law that exempts them from creditor claims. Again, what's the reason for the federal law? The reason is they want your retirement benefits to be there when you retire. So if you play the game, you lose, you file bankruptcy, you still get to keep your pension plans. Why are they popular? Tax rates have gone up. 39.6%. Plus, we lost PEP and Ps. What's that? High-income taxpayers have actually had some of their deductions withdrawn from them in ARDA. So right now, what we're looking at is rates as high as 53% for certain individuals. We also have new rules that they want your plans to be fully funded. I was going over a survey just yesterday. The large, big traditional defined benefit plans, guess what? A lot of them today have not recovered from the crash in 2008, and they're still not fully funded. Unlike a fully insured plan, you're almost always fully funded. As long as your client continues to fund in the plan, they're going to be fully funded, and you don't worry about those compliance issues. So why fully insured? Well, first of all, the PBGC and insurance companies provide some of these guaranteed results, and the plan sponsor makes up the losses. So let's look at following comparisons, which we went over. Overfunding and underfunding penalties. In a traditional plan, they exist. Fully insured, you get rid of them. The financial reporting under FSAS 158 is a balance sheet item. It used to be a footnote. Okay, fully insured, you always fund, you're always guaranteed. A traditional, you may have to report a loss that affects your balance sheet. Schedule SB on the Form 5500 must be signed for a traditional plan. Schedule SB, you do not need to sign on a fully insured plan. Why? Because all the benefits are guaranteed and you can calculate them using the insurance and annuity contracts. You don't have to make interest and mortality assumptions under MAP 21. Actuarial valuations. Well, you don't need actuarial valuations. Look at your insurance and annuity contract. It's there for you. FTAP compliance. You don't have to deal with that, which you would have to in a traditional plan. So like I said, you're running it in safe mode and you keep the fees down. Now, if your client comes to you and say, well, I don't mind spending $40,000 to $50,000 a year on fees, or $5,000 to $10,000 to set up my pension. I've never had a client do that, but let's say they did. Then maybe you would want to look at a traditional defined benefit plan. So it differs from case to case. PBGC, we don't have the variable rate premium and other technical issues relating to the plan generally. And the increase based on salary. So what we're doing is we're getting rid of these issues. And you're running, like I say, the computer on safe mode, PC on safe mode, as opposed to mainframe, which is the traditional defined benefit plan. Stocks, bonds, REITs, commodities, we don't have to worry about the market fluctuations in a fully insured plan. I mean, think about it. Your fixed annuity, do you worry about the REITs collapsing or the commodities market going down? No. You know, oil just went down. Oh, it went back up again. You don't worry about that in a fixed annuity. And the penalties, very important. Get rid of these penalties that you could be faced with in a traditional plan. The underfunded plan, the overfunded plans. Wait, we didn't talk about overfunding. Okay, we'll talk about it. Remember I told you about that stock that made 99%? Okay, let's say your client invested properly and they made tons of money in their pension. Now they're overfunded. When they terminate their plan, they're subject to a 50% excise tax on the overfunded amount. So even if you gambled and you won, you lose once you go retire and you terminate and roll the plan to your IRA. So it pays to have in a pension stable value. And by the way, it's not just me. If you go to ASPA, SOA meetings, site of actual meetings, they're all talking about funding into more stable value investments. And also there's a lot of big companies like General Motors who have took their terminal funding benefits and moved them over to insurance companies because they don't want to deal with it, because pension plans are meant for stable value. 401k plans, IRAs, profit-sharing set plans, they don't have the penalties. So put your gambling money over there in the 401k. If you make a lot of money, good for you. You invested in the fund, you made a lot of money, good. If you lose, bad for you, but there's no IRS penalties, unlike a pension. So put your stable value in your pension plan and your unstable value over there. So we talked about that. No overfunding, no underfunding, no FAS balance sheet items, no Schedule S of B, no FTAP, no PBGC variable rate premium. This is one reason you use a fully insured as opposed to cash balance or a traditional plan. So 412(e)(3) plans are fully insured, and they have guaranteed returns. Historically, what I've seen, 3%, usually the low, 7.85 is the high. So it usually hits those ranges. Right now it's been around 3 because the market's been down. And usually they'll average over a period of time 4 to 6%. I tell my clients, you're not going to hit home runs with these, but you're not going to get strikeouts either. I mean, that's just the name of the game. You know, no home runs, but no strikeouts either. So no worries about the stock or bond investments, which everybody's concerned about. I was at a presentation just the other day. Jeremy Grantham, which you're all familiar with, who is the person who says the market regresses to the mean, and Warren Buffett says you need to follow Grantham, said this, and I thought this was very interesting. This is what the speaker said. They believe that the market over the next 7 years is going to average about 2%. I was going, are you serious? Which means if that's true over the next 7 years, you're better off in a fully insured plan, which usually averages between 4 and 6, but usually minimal of 3. So the fully insured plan offers also other tax planning opportunities. We're going to take a look at a case study. So with that, I'm going to invite back Max Coulliette, and we were going to look at a case study relating so how you can actually use this in your practice so it can help you and also help your client. So we'll bring back Max.
Okay, I'm back again with you to talk about the fully insured plan and some of the tax opportunities it offers, because this is a major motivation in this plan for clients to participate. First of all, when you have a married couple making over $450,000, they're at 39.6 in federal taxes. Plus, there's some state taxes that'll get involved. Plus, you've got the Affordable Care Act, or as we lovingly refer to it, the Obamacare surcharge of 3.8% of modified adjusted gross income, plus payroll taxes of 15.3. Now, what can that mean? Well, if you take a look at the state income taxes, we look at over on the West Coast, we have California over here, and where are they at? 13.3%. So if we were to combine that now with our federal and the Obamacare surcharge, the FICA and FUTA taxes, we're up approaching 60% or more in taxes. That makes it a very motivating transaction for those people. In fact, I'm going to show you an example here just briefly of a case that we did. This was a doctor, age 57. His wife was a nurse practitioner. He is a doctor, and he was making $493,000 in his practice. So what was he doing? Left to his own devices, he was going to do a 401k profit-sharing plan. The 401k profit-sharing plan, that particular year, he was going to put in $55,000, maxing out what he could put into that plan. So his net income's about $438,000. Now the tax on that and the after-tax income, it works out to total taxes of $193,600 and change. A big tax bill. Now, on the other hand, he says, I don't necessarily have to have all this income. My biggest concern is retirement, because he fit the classic doctor profile. I've seen this over the years that I've been doing these plans and working with Nick. We run into the doctors, just to pick on them for a second, and they have worked hard, they've gone to school for a long time, they have student loans, the cost of getting into practice. They suddenly wake up, they're 54 years old, 57 years old, they look in the mirror, realize there's a lot of silver on the roof, or maybe there's a lack thereof, and so now they're saying, wow, I've got to save for retirement. And they open up their 401k and their IRA statements and get out the calculator, and they see, I've only got $420,000, and I made $490,000 last year. How am I going to retire and have a lifestyle remotely close to what I've been enjoying? Well, they can't, because they can't get enough money put away in the traditional plans. So what do? We introduce them then to a fully insured defined benefit plan, a la 412(e)(3). So in this case, the doctor could have put away $238,000 and change into a 412(e)(3), but he says that may be a little beyond my cash flow budget. By making some alterations to our formulas in the plan, we put away $205,000, which he said will fit. So $205,000 going into the plan contributions, and as you can see here, when we get to the bottom line, we've got $95,000 in taxes versus $193,000. So when you take a look at that, the net benefit and tax savings was $98,640. Now, did the doctor win? Was he happy? Absolutely. The other benefit in this particular case, the doctor, of all contributions to the plan, even for his employees, got 91.5% of all contributions for his benefit. Now, I don't know about you, but as we deal with clients out there and we work with those doctors, how many of them would rather give more money to the employees? No, they want to give more money to me. Is that right? That's the way they all think, and that's the way most of them are. And plus, in the traditional plans, they're being discriminated against, and once they really understand that and wake up and realize that, now they're more motivated. And this is a very tax-motivated process. So here's a comparison of another case study. This is a medical group again, and here we have a 401k plan, and what's the maximum we could get into this? Well, the key people, the doctors in this case, 49%. Okay, the profit sharing, 48% of total contributions. Traditional DB plan, 50%. A cash balance plan, 52% could go in for that key group. By using a cross-tested, fully insured plan, so a 401k profit sharing plus the combination of the defined benefit plan and the fully insured defined benefit plan, those key people, those doctors, got in 93%. Now, I don't know about you, but my experience is when I can say, here we can max you out at 50% of what you're putting into it goes for your benefit, or we can get 93% in for your benefit. Which would you prefer? I've never had someone, tell me, well, let's just get 50% for me. I don't want that larger number. And so which is best for your client situation? And I would tell you that in most cases, the doctors are going to prefer something like that. So when you're combining, doing a DB-DC combo, as we refer to them, or custom carve-out, we custom design the plan. We review the census, we look at all that, and that's where we're having someone knowledgeable about these plans to look at how it can be constructed can make a big difference. Because these plans, in a traditional DB, you have to have stable value investments. In the 412(e)(3), you don't have that issue because, as Nick talked about, we're using guaranteed insurance contracts. In a diversified portfolios of the DB in the defined contribution plan, what I also say is if you have this fully insured DB plan, you've given yourself a permission slip to go over here on your 401k assets and your IRA assets and be more aggressive, because you've now got your guaranteed money. I also am an investment advisor. In doing that, I can tell you that a moderately aggressive investment portfolio will typically have about 22% of the assets in guaranteed instruments, a la your DB plan or your fully insured DB plan. So doing that, you can bring stable value to a small business or a smaller investment portfolio, still allowing them to have the investments that, as they say, they like to talk about at the family reunion or at the golf club, because they made 47%. They don't want to talk about 2008. So with that, 6% of pay can be placed in into the defined contribution plan under the new Tax Act without penalty, triggering a 404A7 disclosure. We don't have those issues. You can set it up for automatic enrollment. There's a lot of features that can be combined here to make that simple to administer. Now, to do all that, you need to have a TPA involved, and that's a third-party administrator. And why is that important? First thing I will tell you, we've been doing these for a lot of years, and these numbers do not vary a lot. When we work with an advisor who gets us involved, for an example, as the third-party administrator in the whole process with the client, we're doing business with 60 or 70% of the clients that they brought to the table. When the advisor says, I don't need help, I can do this by myself. Sounds like my granddaughter when I was trying to do her hair for church the other day. But in that case, we only close about 5%. So it makes a difference because you've got plan design and support. That's very important. And the plan design not only includes the actual structure of the plan in terms of who participates in the defined contribution, who participates in the defined benefit plan, because that can be important. In that particular case I showed you of the doctor, his wife was a little upset with us at first. He says, why do you want this receptionist in there? She's 23 years old. She's not going to be here long term. I said, perfect. We want her in the defined benefit plan. Okay, and I had to go through and explain it to his wife. And it took, I think, 2 or 3 times, and she finally said, I think I got it. That makes sense. But that's critical. That design is very important. And support and design and looking at the right products. Nick and I had a case, I guess it's been 2 years ago now, where we went to the enrolled actuary and said, we got a problem with this plan. Here's the issue. And he was a separate administrator. He now happens to work with us. But he says, I don't know anything about these products. We called the insurance company, and the first call, the insurance company said, oh, we do these all the time. And I said, well, let me talk to your supervisor. Let me talk to your supervisor. By the time I got to the third supervisor, it was a chief legal counsel. And he finally said, Mr. Coulliette, I need you to get off the phone. Put the client on the phone and please take us off the speaker. A moment later, the client holding the phone said, they're offering me this. Should I take it? I said, good deal. Because, and he says, he just wants me to sign a hold harmless agreement. Well, yes, because what they had done was wrong. And so you need that. You also need the testing to be in place to make sure this plan is staying in compliance. You need a product that has stability in it. I get the question all the time, can't I use an indexed universal life or can't I use this product? You can't. It has to be a whole life. It has to have that stable value and absolute guarantees. And it requires legal documents, and the legal documents can make a big difference, okay? And there are Form 5500s, there are filings, there are actuarial calculations. And they're not simple calculations. You have PBGC filings. And then at the end of the day, you're going to have a plan termination, which again is not a simple thing to do. So that's where a third-party administrator comes in and is critical to the success in these plans, and especially a third-party administrator that knows something about combining defined benefit with defined contribution, number one, and number two, not only defining defined benefit with defined contribution, but also understands the products in the fully insured plan. Just like the enrolled actuary, bright gentleman, has a master's and, etc., and believe me, if he passed the enrolled actuary exam, he's got to be fairly smart. He did not know enough about products to make sure that the right products were in the plan to make it compliant, and therefore the plan was totally out of compliance. So those are all important things. The plan design is the biggest issue up front because it has to be really customized to the client. It's kind of like I always jokingly say, and I can kind of get away from that with this. You'll notice when Nick and I were standing up here, I'm a little bit larger than him. I know we could trade suit coats. I know he could get into mine. It might look a little funny, but he could get into it. Now, on the other hand, I will be dramatically challenged to get into his. One size does not fit all, and that's the same with these plans. There are a lot of things that can be customized to the client's specific situation based on the original formulas put into the planning. You also have the plan administration is very important because it has to stay in compliance. So you have to have someone that knows what they're doing there. And plan funding, due diligence to making sure that you've got the right products in the plan are so important, and that the funding is appropriate. Had an advisor call me the other day. A TPA had created a plan, and when I went through the math, I said 57% of your contributions are in the life insurance contract. He said yes. That's the way that they devised it. I had our people do the math on it. They said this plan is overfunded by $104,000. Okay, there are problems because you cannot make those adjustments. So that's why all these things are important that we've talked about, the due diligence, the compliance in these plans. Nick and I always like to design them with a safe harbor approach in the way we like to do it. Let's, as Nick says, do something that's defensible if we ever have to go to court. And fortunately, we have been audited, but I think in the whole time that we've done these, we've had a handful of plans go to audit, and we've had, I think, 2 or 3 that ever had any very minor changes, but that's where it's important to do them correctly. So if you wanted more information, feel free to contact us. Thanks for taking the time to listen to all this, and hopefully this has been helpful to you and can help your practice.
Thank you for participating in this program. For more information regarding products, programs, services, and other NAIFA member benefits, visit www.naifa.org.